All right, so the Finance Minister, Tito Mboweni, completing his budget address for the 2021 year this afternoon, and some figures that suggest while the economy is still in the doldrums, there are some silver linings here and there. And just to look at some metrics before I bring in the chief telling us. Your tax revenue, by the way, in October was set to be 300 billion rand short of target. A little bit of an improvement, in fact, 100 billion rand of improvement. It's coming in at 213 213 billion rand of a shortfall. GDP, that's economic growth, expected to grow at 3.3%. Your budget deficit, that's the difference between the money we collect and the money we need to spend to meet our obligations, is sitting around 12.3% for this year. So an improvement from 15.7% the last time we heard in October. Of course, debt to GDP is the big, huge number that the ratings agencies look at, 88.9% in 2025. If you recall, in October, our debt to GDP was forecast to be 95% and then stabilized. But this is the big one here. 20% of our revenue that we spend goes towards servicing our debt, and it still stays that way. And at that point, I want to bring in the chief economist at Alexander Forbes there, Mhlanga. Isaiah, thanks very much indeed for talking to us. So the budget is said by the finance minister not to be an austerity budget. It's anything but that. What do you make of it?
Well, I think overall it's a good budget, considering the current environment where we are. If you just look in terms of the current fiscal year, better than expected tax revenues really simplified things for National Treasury, enabling it to spend more on health, on procuring the vaccine, but also putting aside a contingency reserve that can be drawn upon if we need to spend more in managing a third wave, but also even a fourth wave if it comes. And that's a very good thing. But also an extension of support for those that have lost jobs until April, which in my view is insufficient because the impact of COVID is going to be with us well beyond April. But if you just look in terms of the fiscal stance, a reduction in the debt to GDP ratio where it's supposed to peak, which was estimated at 95.3% of GDP in October 2020, is now expected to peak below 90%. That's a 5 percentage points of GDP. That's 250 billion rand in reduction in that debt to GDP ratio, which is very important for bond markets, very important for investor sentiment. And you have seen already the rand and the bond markets have adjusted. And that's important in terms of attracting portfolio inflows that we also benefit in terms of funding the current account deficit. If you look in terms of the other expenditure items, capital investment is maintained while the wage bill is reduced, which is a good signaling from National Treasury to say we need better quality of spending in the budget than what we have had before.
Let's just talk about some of those apprehensive aspects just ahead of this budget. We thought there's a possibility that we may be paying for a vaccine from the tax. That didn't happen, and I would imagine it's because of that good fortune on the tax front. We also thought that perhaps we could get some personal income tax hikes. That didn't happen as well. So I would imagine, and again I point over to that windfall in tax over the November and December period. Isaiah, it looks like that really helped, didn't it? The question is whether or not that sustainability can last through the year.
Look, even in the absence of better than expected tax revenues, it would have been ill-conceived for National Treasury to hike personal income tax in the middle of a pandemic when people are losing jobs. You don't see that anywhere in the world. So it is a good move by National Treasury saying the 40 billion that they had penciled in before the pandemic in tax increases is now reversed. Maybe in future when economic growth picks up, that will be okay. But at least for now, there is a cushion for those that would have seen their incomes drop because companies have been cutting salaries and wages in order to deal with the pandemic. But also, if you just consider that fiscal consolidation the world over historically has never been achieved on the basis of increasing taxes. It has been achieved on two things. One, which is a reduction in expenditure, particularly for current spending, which is what National Treasury continues to do as far as the wage bill is concerned. The second point is economic reforms that attracts investment from the private sector. And we had a reduction, a 1 percentage point reduction in corporate income tax. That will play a role, but we need more faster reforms as far as energy is concerned, spectrum is concerned, which unfortunately lies outside of National Treasury's control. So that's where one of the big execution risks lies as far as lifting economic growth. But even when you consider the baseline focus from National Treasury, they do not seem to pencil in a good reform progress ahead because, I mean, we see a decline, a moderation in economic growth to 2.2% and a further moderation in 2023 in economic growth. Right. How does that happen if we were to receive economic reforms that boost investment?
All right. Thanks very much indeed. We're going to have to leave it there, but quite right. And I guess the question is whether or not the policy adjustments or change lies within the ambit of the Treasury. It certainly doesn't, but some interesting insights there is Mhlanga, the chief economist at Alexander Forbes.